Good morning, students. I am Harjot Kaur from Arya College, Ludhiana. Today, I am going to discuss accounting concepts and accounting conventions. Firstly, we will see the list of various accounting concepts: business entity concept, money measurement concept, going concern concept, accounting period concept, cost concept, dual aspect concept, matching concept, accrual concept, realization concept. This is the list of all accounting concepts. Before explaining each concept, one should know the meaning of accounting concepts. Accounting concepts means the assumptions on the basis of which financial statements of a business entity are prepared. It means the postulates which an accountant should follow for preparing the profit and loss statements and balance sheet of a business firm. Now, I am going to discuss the first concept, that is business entity concept. As per this concept, there is a separate legal status of business and its owner. The property of the business, name on the name of business, not on the name of its owner. All the transactions in the books of accounts are recorded from the viewpoint of business, not on the name of the person who invested money in it. There is an example for business entity concept. Uh, a businessman started business by investing his funds in business. The investment in the business by the businessman is known as capital, and it is treated as liability for the business, as it will be paid back to the owner when the business is wind up. Next is money measurement concept. As per this concept, only those transactions are recorded in the books of account which can be expressed in terms of money, or in other words, non-monetary transactions will not find a place in the books of accounts. There is an example for the money measurement concept: sale of good worth rupees 2 lakh, rent paid 1 lakh. As both of these can be expressed in terms of money, they have money value, so they are recorded in the books of account. However, there are certain assets which cannot be expressed in terms of money, like sincerity, loyalty, so these cannot be recorded in the books of accounts. Good morning, students. I am Harjot Kaur from Arya College, Ludhiana. Today, I am going to discuss accounting concepts and accounting conventions. Next concept is accounting period concept. As per this concept, transactions are recorded in the books of account on yearly basis so as to get the result of profit and loss and balance sheet at regular intervals. As per the going concern concept, it is assumed that business will go on continuing its operation for a long period of time, but the owners of the business are impatient. They cannot wait for a long period of time in order to know the profitability of a concern. So it is better for a company to prepare its accounts on yearly basis. Normally, accounting period is of 12 months, but in case of newly started business, it can be less than 12 months. Next is cost concept. As per this concept, asset is recorded at a value at which it is acquired, or the purchase price paid to acquire a asset will be recorded in the books of account, though the market value of asset is increasing, but as per the rules, only the cost at which asset is acquired will be recorded. The advantage of this concept is that it brings objectivity in the books of accounts. Next is dual. Next is dual aspect concept. This concept believes that every transaction has a dual effect, that is, every transaction affects two accounts in opposite sides. In other words, for every debit, there is a credit, or both the aspects of transaction must be recorded in the books of accounts. This concept can also be explained in terms of an equation, that is, assets are always equal to liabilities plus capital. Next is matching concept. Matching concept says that in order to know the ascertain the correct profit of a business concern, all the revenue, whether received or not, should be matched with all the cost incurred, whether paid or not paid. That is, all the revenue should be matched with the cost in order to know the correct profitability position of a concern. Another concept is realization concept. According to this concept, revenue is considered as being earned on the date at which it is realized, that is, on the date when the property in the good passes to the buyer and he becomes legally liable to pay. Selling goods is realization, receiving order is not. There is an example for realization concept, that is, a manufacturer receives an order to manufacture goods on 1st January. He dispatched the order on 1st February and receives the payment against order on 1st March. In this example, on 1st February, it is assumed that revenue is realized as the property in the goods passes to the buyer and the seller is legally has a right to receive the payment. Next concept is accounting period concept. As per this concept, transactions are recorded in the books of account on yearly basis so as to get the result of profit and loss and balance sheet at regular intervals. As per the going concern concept, it is assumed that business will go on continuing its operation for a long period of time, but the owners of the business are impatient. They cannot wait for a long period of time in order to know the profitability of a concern. Now, the next topic is accounting conventions. This is the list of accounting conventions. There are four main accounting conventions: convention of consistency, convention of full disclosure, convention of materiality, convention of conservatism. Before discussing each convention, one should know the meaning of convention. Convention is a general belief or custom or tradition which a business firm is following for a long period of time. In other words, one can say that convention serve as a guide for preparing the books of accounts. First convention is convention of consistency. This convention says that same set of principles or same rules should be followed year after year so as to make the accounting statements comparable. One example of convention of consistency is that if a company charges depreciation on its fixed asset on straight line method in the first year, then in the second year until the end of the useful life of an asset, the company should follow the same method of depreciation, that is straight line method, as it helps the company to make the comparison of the value of an asset of the current year with the previous year. Next convention is convention of full disclosure. According to this, all accounting statements should be honestly prepared and should disclose the full information to the interested parties. Proprietors, creditors, and investors are the interested party who should know all the information regarding the business concern. So, it is the duty of a business to disclose all significant information to the full extent in the books of accounts. It should not hide any significant information. Next convention is convention of materiality. This convention says that only material information should be disclosed to the interested parties, as these parties know the significant information. They do not want their time to be wasted, so it is a duty of a business to disclose them only the significant information which will influence their decisions in the business firm. Next convention is convention of conservatism or prudence. It is a policy of playing safe, or it safeguards a business concern from all kinds of possible losses, or it is considered as a risk proof jacket for a business concern. This concept assumes that anticipate no profit but provide for all possible losses. In other words, for all possible losses, business house should set aside a certain sum of money so as to continue the operation without any disturbance due to the losses which will happen in the future period of time. One example of this convention is provision for doubtful debts. As there is a doubt regarding the payment of debtors regarding the credit sales, so it is better for a business to prepare or to set aside a sum for such risk, that is known as provision for bad debts. I hope all of you understand the accounting concepts and conventions. Thank you. Thank you a lot.